Good evening, everyone. We're going to get started. Welcome to our Zoom line guest. My name is Veronica Pasaran. 14 years ago, I was sitting in one of the chairs, that you're sitting today, and I was impacted by this information. At that time, my husband became ill, and shortly after that, he became disabled. So my brother said, our lives have been shaken up. My brother said, you really need to come out and take one of these classes, right? Because we thought we had our things in order. So I come out, and the first thing that I was thinking was, how is it that no one is teaching us these concepts? I just found them so powerful. Like no one, how is it that it's like finish the degree, right? You're going through life and you don't know these concepts. So I'm an architect by trade and an educator by heart. After learning these items, these concepts that you're going to learn tonight, you're going to see the value and the importance of them, right? This, learning and working, I've had an opportunity to work very closely to our first speaker. He is a family man, has two beautiful daughters. He loves spending and playing golf on Fridays with his youngest. He has over 30 years of experience, and I'm fortunate and grateful to be working by his side and learning and helping families. So without further ado, my mentor, Todd.
All right. Good evening, everyone. Here live in our office in Oak Brook, as well as in TV land. We welcome you all tonight to learn. I guess I have to grab this clicker here and go to advance this thing. So this is a little bit about. I want to share a little bit about this book here. As Veronica mentioned, she sat in a class similar to this 14 years ago. Well, we've advanced quite a bit since then, even in the fact that we really wanted to put together a curriculum that was for everybody to learn how money works. Since it's as you're going to see a big problem. Financial literacy is a huge issue the world over, and definitely in the United States. And about 6 years ago now, one of my mentors, a guy by the name of Tom Matthews, wrote this book, How Money Works. And the tagline there says, "Stop being a sucker." So that's kind of like, wow, a little in your face, right? Stop being a sucker. And the whole idea that, not too many people I know like can't wait to curl up with a financial book on the weekends. But there's a big problem about financial literacy. So the key of this book, and hopefully, has anyone ever read this before in this room? There's a few people that read it. Okay, so you're here because you've read this book. Some of you who are never seen it, oh, we got to get a copy in your hand, sir. Okay, make sure Ramon gives you a copy. Anyone who's at home, if you haven't gotten a copy of this book, make sure the person you invited on tonight at the Zoom gets you one of these in your hands, okay? Because the whole purpose of this is to, in a couple-hour read, you could probably learn more than 95% of people about personal finance. You'll probably be right up. It's to level up our understanding of how money works. Because who thinks that understanding how money works is, or just money in general is kind of an important topic? What do you think? Yes? Like close to oxygen, maybe just a little underneath oxygen, food. It's like a hierarchy of needs, right? Money, because you need money to buy food. So certainly that comes into play. And so understanding how to make better decisions around it is pinnacle. And so our founder, Mr. Tom Matthews, happened to go on 250 different TV shows and networks across the country over the last 6 years. Over 100 million people have been exposed to this book. It's a bestseller in its category on Amazon right now. So really proud of the work. So the class tonight is the essentials of that book. So it's the kind of like the first class of bringing the book to life. So certainly we're not going to it's not going to be like super deep. We're not going to talk about derivatives and options trading. Like that's not what this is about. This is about simple stuff that everyone needs to know. And it's broken down into two parts. I'm going to do this first part, just sharing some concepts. And then my partner Chantay is going to come up and talk about implementation of how to craft through our 7 money milestones, how to build a plan for yourself in your future. So the first decision we all need to make is a simple one. Do you want to think like a sucker or learn to think like the wealthy, right? And it's easy to think like a sucker, just follow the masses, right? But the good news about learn to think about like a wealthy person thinks, so you don't have to be wealthy to think like a wealthy person. You just need some knowledge and action. And so tonight we're gonna teach some of that knowledge so that we can prepare you for some action. So financial illiteracy is the number one economic crisis in the world. And we have proof to back that up. It's just not like some statement, but Just think, I mean, the word sucker, we said, stop being a sucker. Anyone offended by that? Everyone take offense, like, yeah, am I a sucker? What the heck? That seems kind of harsh. Well, not understanding how money works, you're offended. Good, you are. Get out. You could stay to the end. So we're going to help you not be that, okay? And because being a sucker, especially around understanding how money works, just making better decisions. But if you don't understand how money works, it sucks up your time, it sucks up your freedom, it sucks up your income. All things that none of us can afford. Here's the thing. It's not our fault if we are a sucker, because I was one, okay? It's because it's 30% of the people in the world know anything about what I'm talking about right now. That's a problem, right? 100 years ago, a lot of people couldn't read and write, right? Well, not understanding how money works is today, 100 years later, is kind of an equivalent of that, wouldn't you say? Mm-hmm. And so we know that 44% of Americans, almost half Americans, can't afford to put a new set of tires on their car without going to the debt. Almost half of student loan borrowers are not making a payment right now. Almost $10,000 is the average credit card balance. That means a person who owes that much as a balance is going to pay about $37,000 in interest in their lifetime. A third of Americans, 1 out of 3 people, zero saved for retirement. Is there going to be a problem when it comes to that? Yep. It's going to be a huge problem. It's a crisis we haven't even seen yet. And one of the biggest challenges that we see is that it's just not taught in schools. 28 states out of 50. I bet 50 out of 50 states, they teach sex ed. Unfortunately, something many teenagers can figure out on their own. Okay. Unfortunately, right? But the fact is that half the states, and the ones that do, what do they teach? Here's how you balance a checkbook. Here's how you, do basic things that don't really move the needle. And so it's not our fault. Our parents, if our last name's not Rockefeller, they probably didn't know either. My parents certainly didn't know. They didn't know anything. They're both teachers. My dad was a athletic director. My mom was a home economics teacher. Home economics is not the same as financial literacy. That's sewing and cooking back in the day, right? Now it's called tax class, okay? So meet the sucker cycle. This is me, actually, when I started in the business. I was 23 years old in my 5th year at University of Illinois, okay? Because I love school so much, all right? Well, when I was 18 years old, I got bit by the entrepreneurial bug. I started a painting business. It was a painting franchise that I got brought in, learned how to paint houses. I learned how to have a bunch of my high school buddies do the same thing. And then I learned how to quote all the things you had to do to produce a job to get paid. I did that for 5 years. And I kind of moved up. Every year I made a lot more money than the year before. I was making way more money than my friends. How much did I have to show for it? Not much. Nothing. Want to know why? Because I worked so hard for that money. Does anyone work hard for money? Yeah. So when you work hard for money, don't you think you deserve to spend it?
Yeah, absolutely.
You deserve to spend it, don't you? Yeah. On what? On things that are going to make you happy when? Right now. But tomorrow, will you remember the thing you had yesterday that you spent the money on? It's called fleeting things, right? Well, I did buy one thing that did stick with me. I'll never regret it. It was a Toyota Supra, Target tops, red. I was a BMOC. You know what that means? Big man on campus. Yeah. And so I drive around in that thing. I thought I was something. I was 20 years old with this thing, right? But hey, you know what? I was everyone's best friend at the bar. I was always the first. I'd love to have money in my wallet to make me look so like something. Because I thought if you're successful, you have to do what? Show everyone you're successful naturally. You have to do that, don't you? Isn't that how you're supposed to do it? Okay. I remember one day on the quad, I was thirsty. There was someone giving away 2-liter bottles of pop. Like, they're just giving that away. Okay, I'm thirsty. I'm gonna go over there and check it out. Hey, here's your bottle of pop. Great job. Not so fast though on that bottle of pop. First, we need to have you go ahead and fill out this application for a credit card. Yeah. Oh, credit card sounds good. My roommate, who's an expert, he knows everything. He said you should get credit cards and spend lots of money on credit cards to help you do what? Build your credit. Man, this is great. I can drink this pop and get a credit card. 2 things I could check off my list. And of course, 2 weeks later, I got $10,000 limit in the mail. Just came right to my dorm room. And here I am, $10,000 credit card. Couldn't be happier to go spend up on that credit card. I'll pay for it later. You want to know why? Because my business is growing and I'm going to keep on making more money. And I'll just pay for this now because I want it now. Isn't that the way to do it? So the sucker cycle is you get a paycheck, you buy a whole bunch of crap you don't need, and you'll forget about its value and utilization tomorrow. And then we end up spending everything and saving nothing. That's the sucker cycle. And that's where 2/3 of Americans are right now. Okay. That's why we're in a crisis. And here's the thing, go back one step. Again, who likes to spend money? What do you like to spend money on? Okay, but what? What specific things? Eating out? Okay. Travel. Entertainment. Are you going to want to eat out, travel, and be entertained 20 years from now? 30 years from now? For the rest of your life? What happens if you're too old and decrepit to work still where you can't pay for it? That's where you have this problem. It's your retirement plane. Any plane, last I checked, needs 2 wings to fly. Okay. Well, this plane's only going to be going in circles for most people if it even can get off the ground. Because 40% of your retirement is supposed to be covered by Social Security. To the extent you think that that'll be in there the same as it is today. The average balance in 401k plans from people 60 to 69 years old is $195,000. $195,000. If you make $60,000 a year, $70,000 a year, how many years is that? 3 years? So that's a little bit of red, lots of blue. This other wing is missing. Okay. What's the other wing? It's got to be all yours, what you did. Self-security, right? Here's what millennials have saved for retirement. 23,000, Gen Xers, 66,000, huge. Baby boomers, 152. There's a problem. The problem, and I keep on pressing the wrong button is the problem. We're going the wrong direction. So look, will your savings run out in retirement? For a lot of people, the answer, unfortunately, is yes. They're going to be getting to this point where there's a gap. And they may start retirement, but even if their plane gets off the ground, it'll be right back to earth as soon as they have to ask their kids, can I live with you? Or I may have to go back to work. Or you ever see people who are working places that's like, oh, poor guy or poor gal. They're not doing it because they love to do it. All over and that's sad. Okay. And this is the reality, a restricted life. Hopefully you like your kids. Okay. Now we'd all like to have to get to the top of the mountain, right? And you know what? There's probably a lot of people here and also on the Zoom call tonight who are doing quite well. You've got a lot of things in place. You've maybe saved a bunch of money. You've got the pile. You got the pile for your FIN. You know what your FIN is? The more important than your Social Security number. It is your financial independence number. Okay. Maybe you've got that. But there's a whole bunch of Sherpas in the Himalayan mountains that'll tell you most people don't die on the way up to the top of the mountain. They die on the way down. Okay. So if this isn't for another advanced class, but when you're in a situation where you've got what you think you need, are you going to use that as an ATM machine now, your retirement plan, whenever you need money, or are you going to have a disciplined withdrawal plan, a way with taking advantage of tax advantages, making sure you have a bucketing strategy. There's so many different ways to make sure you don't run out of money, but also have more of a legacy than you maybe otherwise would have. Okay. So even when you get here, we still have to keep in mind what that looks like on the other half. Now, I'm going to cover a couple things here. Compound interest is the magic that makes all this stuff happen. It's like interest on interest. Yeah, that's what compound interest is. Okay. So there's a couple things that I think blew me away when I first saw some of this information. I was 23 years old and I said, I don't think I'm going to paint any more houses. Okay. Because I wanted to do this as my business after that. But Albert Einstein called this the greatest invention of all time and mankind's greatest invention. Compound interest is the greatest mathematical discovery of all time. Albert Einstein, kind of a smart guy. So which one do you think Albert Einstein would prefer? Simple interest or compound interest? Compound. Let's talk about the difference in each of these. So simple interest, you just receive interest on your original principal amount and add it each year. Compound interest is where your interest can grow on top of itself. So simply, if you had $1,500, you started at zero age, okay, with $1,500, right? At 9% return, that's $135 of interest. Simple interest is every year it just adds on $135. So by the time you're 50, $8,200. A little different than compound interest, where every year the interest grows on top of itself and you get that 9% on the next year's balance. Okay. Now, how often this is compounded monthly? Do you think that it's more important to have your when you do have compound interest to have it compound more often? Now, when you're in the stock market or you're in the mutual funds or in something like that, it compounds daily, right? If you're at a CD, it could compound a lot. It doesn't compound. It's simple interest actually in many cases, or compounds only when they buy the interest, right? So you always have to keep in mind how often compound interest actually compounds. Okay. So in the next example I'm going to share with you, this is someone putting $178 a month away from 25 to age 67. Okay. So just just to show the difference in how much a rate of return actually means when it's compounded. So here's that 1% example. Let's say you got 1% on your money. That $178 a month from 25 to 67, 111 grand. 3%, a little bit better, 179,000. 6%, 404,000. Or you could have over $1 million if it made 9%. Which one would you choose? Okay. I hope everyone got that right at home and here. So that just means you want something to compound, number one. Number two, you need to get a little bit better return, right? The difference between 3 and 9 is it's 3 times as much return, but is it 3 times the money? No, because the compounding effect makes a big impact, okay? And that's where we get into the time value of money as well. How long? Time is the other element. So rate of return, does your money compound, and how much time do you have? When did you start? So Sarah is smart, okay? She decided to start early. So she at 22 years old, she wasn't everyone's best friend at the bar and having a whole bunch of other things to do with her money. She said, I'm going to put away $333 a month, $4,000 a year, and from 22 to 30, just 8 years, and keep it in an account, okay? I think this is a 9% example. Yep, 9%. By the time she's 67, she has $1.4 million. Not bad. George, on the other hand, George's like, nah, I have a lot of things to spend my money on to make myself happy right now. When I'm 30, that'll be plenty of time. He saves the same amount per year, $4,000 a year, but does it 38 years, not 8 years. Okay. Who has more money? It's crazy, right? Isn't it nuts that someone can save 38 years, $4,000 a year? They put in 152 grand versus 32 grand. Yeah, just because they started 8 years sooner. That's wild to me. So when someone starts, makes a big difference. If you're 25 years old, okay, and you want $1 million by the time you retire, just stop going to Starbucks. That's it. That's your plan. That's hard. That's how hard that is. Just being one conscious effort to not spend unawares, right? Now, when you start getting to 50, it could be half your check to get to the same point. You may not have a choice, but now you start seeing, do I like my kids? This is where you start looking, do I like my kids? Because I might have to go back and live with one of my kids. That's reality. This is at 9%. So starting early, look, if you were going to plant a tree, you're going to plant a tree that you can enjoy the shade. When would be the best time of your lifetime to plant that tree? No, it would have been when you were born. Yeah. Right? In your lifetime. Right? Now, the next answer is, if it hasn't been planted yet, when's the next best time? Now, not like, when it's convenient. When this bill goes away, when my kids finally out of daycare, when I finally get, when all these when this happens, when that happens, then it's then you're 50 and you haven't done anything yet. Okay. So this is a cool concept. This is called $1 Million Baby. And it's really just common sense way. And we actually have a plan out there. There's an account now that is available for newborns that you get $1,000 at birth. Did you know that right now? That's going to help people really, I think, understand and wrap their minds around this concept. Actually, this is exactly what it is, we want to have our kids do well. Yes. Now they say you got to put your own oxygen mask on before you help others. Right. So you got to make sure you're taken care of. But would everyone here say, now there's always a person that wants to slide in the grave with their last dollar. Okay? I'm not talking about those people. I'm talking about people who want to leave a legacy, do right by their kids. The next generation gets better. Is that what we want? Okay. What if I wanted to leave my kids $1 million? Well, the reality is, for many people, that's hard to do because getting old is a new thing. And used to retire at 65 and die at 67. Now we're living in our 90s all the time. So longevity means that I need more retirement assets for myself. I got to have my own oxygen mask on, right? Medical bills on average, 122 grand during retirement on medical care. Doesn't include long-term care, which 70% of people will need some kind of long-term care where we need help getting out of bed, putting our clothes on, feeding ourselves, remembering stuff. Okay. Being taken care of. That's $390,000 on average. So there's a lot of costs that maybe weren't there a generation ago. And that may be difficult. Well, what if we could get some of this stuff done now? Let's look at 2 different examples of people who can do this. Dana decided when her baby was born to set aside $13,000. Now it could be Dana, maybe it's grandma, maybe it's grandpa that does it. 13 grand. put in a trust, put in a place that earns a very modest return. We showed examples of 9%. This is 6.5%. Okay. By the time that baby is 67 years old, that $13,000 will be worth over $1 million. Just at 6.5%. Can you imagine if they actually get a decent return? Well, what if I don't have $13,000 now? I'm going to wait until 18. Same thing applies. The time value of money. Remember, that same 13 grand now only gets them to 300,000 by the time they're 67. What a difference 18 years makes. Well, I don't have 13,000 up front, but I could do 2,500 up front, and I could do 250 a month for the next few years and get to that a little bit, 14,500, and get around the same amount. That's doable for most people, would you say? The same thing, right? Same thing applies if we wait until 18. But would we have a problem putting $2,500 down on a used car and paying $250 a month for a used car? Right? Do you see that? Or we could create something for our kids that will be there, maybe worth $1 million or more in the future. Okay. So a variety of ways to do it. At the end of the day, kids will be saying, thanks, mom and dad. I set these accounts up for my kids. I have a 15-year-old and an 11-year-old. I can't believe I'm saying that. Girls. They say you'll be well taken care of if you have girls. I'm like, I don't know. I don't think I want that. They walk in the room. My 15-year-old's like, get out of here. I'm like, okay, I'm out. But hopefully I do something right for him here. Okay. Anyone heard of the Rule 72 before? Okay. This is the reason I decided to come in this business as opposed to anything else I could have done at 23 years old, because I saw this concept, this simple math, mental math shortcut. And in 5 years at University of Illinois, I never saw anything like this. Now, I could have skipped class that day. That's entirely possible, knowing my track record and why it took 5 years. Okay. But I will say, when I saw this Rule 72, it made all what you just saw make sense in a very simple math form. And all it is taking the number 72 and you divide it by the interest your money earns. And that tells you how many years it takes for your money to double. Now, does the Rule 72 cut both ways? Yes, it does. What does that mean? It means if you have debt that's at a certain rate of return, it's doubling for someone else, just not you. So we have always and ever a decision to make on what side we want to be on the Rule 72, the good side or the not so good side. Because it doesn't care who it worked for. It's going to work for whoever puts money there. Okay. But I know that if I have 1% rate of return, 72 divided by 1, right? That's 72 years to double my money at 1%. Anyone going to be alive in 72 years?
Yeah.
Maybe. Modern medicine, who knows? 3% every 24 years it doubles. 6% every 12 years. 9 every 8 years. Or 12% every 6 years it doubles. Crazy. So who wants to get an account that doubles every 72 years? Oh, you raise your hand. This is not Simon Says. I didn't even do that. I even try and trick you. So you raise your, I want 1%. Would you, okay, who would like 0.15%? Anyone want 0.15%? Because that's the average savings, right? You know how many people I run into, they have a lot of money, not a little money, a lot of money sitting there making 0.15%. Well, just get ready for 480 years from now, your money will double at that rate. Pretty good? All right. We're talking, hey, I want to create generational wealth. It's just going to take generations to get there. Okay. Apparently. All right. Well, what about the flip side of that? I get 0.15. And what do you think the bank does? They take that same money and what do? They loan it out to me on the campus at U of I with my $10,000 credit card that I got paying not 22%, way more than 22%. Every 3.2 years, your money doubles. For them, not your money, their money doubles, right? And I'm not here to villainize banks. If you work at a bank, sorry, no, I'm kidding. I have a house because of the bank, right? Banks are great for lending money. That's the business that they're in, okay? And if you have enough zeros behind your name, there's a little roped off section they may take you by. And that's the part where they're going to tell you about the real investments. But before then, it's going to be, did you check out our CD rate, sir? Come right over here. You have too much in your savings account. You should be making 3%. You're a 3% kind of guy, aren't you? That's the problem, guys. So listen, that's my part. I'm going to bring up Chantay to talk about the 7 money milestones so we can learn how to apply some of what we just learned. Let's welcome Chantay. By the way, I just say Chantay. I didn't properly introduce her. Okay. Chantay's been an industry professional for over a decade. Okay.
It's actually 20 years.
That's over a decade. Is that right? I thought I was trying to be nice. Okay. And she's also a great friend and partner. So welcome, Chantay.
Thank you. Everyone give Todd a hand. Didn't he do a great job?
Well, good evening. My name is Chantay Moore. I'm one of the certified financial educators here in our office, and I have the pleasure of talking about the 7 money milestones and how do we take those concepts and apply it to reality, right? You're like, oh, that's, of course, I would like to have $1 million by the time I retire. How do I get there? So that's what I'm going to go over tonight. And, when we talk to folks, because these classes are about taking action, it's getting educated, but then the next step is, what can I do to implement all these great things that I'm learning tonight? Because did Todd teach you something new tonight?
Yeah.
I think we all learned something new. And most people, once they get that education, they know they need to do better. They know they want to, improve their finances. They just don't know how to start. And our company came up with a process. It's called the 7 money milestones. We believe that once you get educated and have a really good look at your finances, if you address all 7 areas of each of these money milestones, you should be okay financially. You should have some financial stability. You should be able to reach your financial goals. And I'm going to take you through each one of these. One is getting a financial education. Money milestone number 2 is proper protection. We have emergency fund and debt management, improving your cash flow, building wealth. A lot of people like to do that. And then protecting your wealth. So I'm going to take you through this journey. The first one is getting a financial education. Now, Todd talked a lot about this book, right? The How Money Works, Stop Being a Sucker. This book came out in 2019. We've actually since expanded our education platform. We have a book that came out after that called How Money Works for Women. How many women do we have that need to learn about money? A lot of women. And then most recently, in this past year, we came out with another book, How Money Works for the Next Generation. I can't tell you how many, when I teach these classes, people say, we need to go into the high schools. We need to be talking to our youth about money. And I love the tagline for this book because it's act now or pay later. Because sometimes when you go through and learn that stuff, you're like, Todd, that's great, but I wish I started this when I was younger. It's okay. No one's holding you at fault. You can get started now, but take the information and teach it on to the next generation. So we have that book as well. So when it comes to financial education, one, we encourage you to go through all of our workshops. This one is just like a general workshop. Like Todd mentioned, we actually we have like a 5-step courses that folks can go through if you want to really deep dive into some of these topics. Read the book. We have ebooks. We have workshops online. You can come in person. But the most important part that I find is that most people fail to engage professional support. And that's where we want to offer that resource. Because let me ask you this. If you're trying to lose weight, who do you go to? Like a dietitian, a trainer. If you're trying to get healthy, if you want to, improve your wellness, who we talk to? Our doctor, a medical professional. Where do people go for like financial guidance?
Sister-in-law.
Your sister-in-law. Hopefully she's a licensed financial professional.
She is.
Some folks go to TikTok, social media.
Co-workers.
A coworker who's probably in just a worse financial situation than you. Yeah, we have someone who their coworker invited them out tonight. Why do we not engage professional support to help us with probably one of the most important topics that we need help with in our life? And it could be the idea of thinking the industry doesn't want to talk to me. I'm too broke. I don't have enough money. That's why our company was built, to help everybody, to help the 99% of Americans that actually need help, that are financially struggling. So take advantage of the resources, and we'll show some of that toward the end. But get for financial professional help. Don't go on this journey alone. Have someone who you can trust, who will not pass any judgment, sit down with you, look at your finances, and take you through this process. So milestone number 2 is proper protection. I'm actually going to spend a little bit of time here. When we talk about the word protection, we're talking about protecting against against losing income, or losing my savings. Or I like to use the word protecting against the what ifs in life, because isn't it often the what ifs that just kind of throw you off track financially? In our conversation tonight, we're going to talk about people passing away prematurely, or maybe a breadwinner of a family is no longer here. How can that financially impact someone? And we believe that every person should look at and consider having proper protection in the form of life insurance. You might say, Chantay, why are you talking about life insurance first? I'm saving money over here in my bank account. Well, if you passed away tomorrow, how much will that savings actually move your family forward? It probably won't last that long. Whereas with life insurance, if you get a proper amount of coverage, we're able to take care of our family for generations. So how much? Some people say, well, I have life insurance through my job, or maybe I got something bundled in with my auto insurance policy. And we say, let's make sure you have enough. We use an example of 10 times your annual family income. So for example, if you earn $50,000 a year, that means you should have $500,000 in coverage. If you earn $100,000 a year, you should have $1 million in coverage. And you're like, why? Why 10 years? Why so much? Because sometimes people think that's too much, right? First of all, do you want to just have enough just so your family can bury you and that's it? A lot of people talk about generational wealth. I want to leave money behind so my kids and their kids will be okay. But we recommend 10 years because especially if your income is significant, if anyone depends on you financially, your income is significant. And you have to imagine your income is all of a sudden taken away, how are they going to continue on with their lifestyle? We recommend 10 years because essentially you'll be replacing that income that's no longer there because you're no longer here. And after 10 years, you think they can figure it out? They should be okay. So we think about, in addition to just, income examples, what about your lifestyle? Me, I'm a divorced mom of three teenagers. Like Todd, I'm like, I can't believe my little ones are getting so big. I think of, if I'm no longer here, I want my children to live in the same home. I want them to maintain the same lifestyle. How many of us know someone where the breadwinner passed away and that family was financially devastated? Or you've seen a GoFundMe on social media. And we're not here to judge. That's the reality of what people go through because they just didn't have the conversation and they probably didn't plan. But, think of factors like your age. The younger you are, typically the healthier you are. If you wait, as you get older, the costs tend to go up. We want to avoid that. What if you have debt? Some debt doesn't just disappear, right? Would you want your creditors calling your spouse or your family members saying, hey, we don't care that so-and-so just passed away. We want our money. What if we had enough insurance to just get rid of the debt? Your income, your financial situation, your health, number of dependents. What if you're a business owner? You bring value to that business, especially if you have a partnership. Like if you're in business with someone else, you can have protection in place to replace your value to that business. And so these are just different factors that we help you to think beyond just paying for the funeral. Does that make sense? Yep. The reality is most people know they need life insurance. Statistics tell us, this is from insure.com from 2020, only 59% of Americans actually do have life insurance, and about half of those people are underinsured, meaning they don't have enough to meet their full need. And the reason why they don't buy it or look at proper protection is, one, they underestimate how much they need. They don't think they need $1 million in coverage when they actually might need that. They also think it costs too much. They overestimate how much proper protection can cost. We're a company that works with, 30, 40 different companies. We're actually able to shop the market and get you the best protection at the lowest cost so that we can actually, I can't tell you how many people are like, this is it. This is only how much it costs. And then they get their, plans in place. And there's two types of insurance you can look at. The first is term insurance. This is short term. Remember, I mentioned I had 3 kids. My youngest is my son. He's 11. My girls are 13 and 17. I have term insurance in place, a 30-year term, so that by the time my son becomes an adult, after that 30 years, he'll be a young adult. I won't need as much life insurance because he'll be, hopefully he'll be self-sufficient by that time. So you can get protection for a period of time, 10, 20, 30 years. It's the most affordable because you're paying for protection for that specific amount of time. And then after it's done, we look at other options. But with term insurance, I talk to this with families, especially if they have young children. If you have people who are dependent on you, we want to get you as much coverage as possible. And we use this to meet your need. What if you own a mortgage? If you own a mortgage, have you heard of mortgage insurance? Do you know that's not insurance for you or your family? Who is that insurance for? For the bank, for the lender. If something happens to that home, that check doesn't go to you, it goes to the lender to take care of that mortgage. Paying for college, running a company, you can use those funds for that. But what if that term ends? Are you going to be in a scenario where you no longer need that life insurance? Most times we still need it, right? 30 years from now, I'm still going to be pretty young. Well, in my mind, I'll be young, but I should still be alive and well. Todd mentioned, longevity is a new thing in life. We're going to still be living a long life. I'm going to need insurance beyond that 30 years. So I don't want to be in a scenario where I no longer have the insurance, but I still need it. And this is when we have to really think about our life scenario. We teach this concept called the financial X-way. When you think about your life, we grow from young to old. And when we're younger, we're on the left side of this wave in the blue section. When we're younger, we tend to have more responsibility, but less wealth. Responsibilities like children, mortgages, debt, credit cards. We're trying to build our wealth while taking care of those responsibilities. And then you're supposed to get to the right side of the curve when you're older, where those responsibilities decrease. Why? Well, the kids are old, they're moving out the home. Hopefully I'm paying down my debt or my mortgage is almost paid off. And you hopefully have been saving enough money to build and accumulate your wealth also. So term insurance, the sweet spot is when you're young and you have significant responsibilities. When you're older in life, that's when we start to have, or when you start thinking about being older in life, that's when we start thinking about having permanent protection in place. And permanent is just that. It's intended to have protection for the entirety of your life. I don't know how long I'll live, but I'm going to have a permanent plan in place to get me there. That's, we don't know when we're going to check out of here. And so having that long strategy, there's many uses. I like this because the term is just for a period of time. That's it. With permanent protection, there's so many more benefits built into these strategies. One, it's life insurance coverage. Once I get the coverage, as long as I pay my premiums, I don't have to worry about it running out or losing it or anything. But Number two, remember Todd talked about long-term care in the beginning? You can actually add a long-term care benefit to your policy to help you take care of some of those healthcare expenses when when you get older in life. And then number three, cash value. Did you know that some of these, actually all these permanent policies, you have an opportunity to grow cash inside of them? I'm going to show you that in a minute. But let's talk about long-term care. Like, why should you care? Like, even me, I'm in my 40s, early 40s. Just to make that distinction. I'm an older millennial, but I even care about this not only for myself, but for my mother. Long-term care, if someone needs that type of care where you can't perform 2 of the 6 daily living activities and you need some help, if you needed that, on average, you will need that type of care for 3.9 years. How are you going to pay for it? Do you think the government's going to pay for it? I mean, they might, but would you get the best coverage, facilities, the type of one-on-one care you might want? Look at those costs. If you want to go to an assisted day healthcare facility, average cost $18,000 a year. What if you want a nursing home? Oh, don't want a private room. $100,000 a year. Some people will tell us, you know what? I saved enough money. I have saved. I'll just pay for it out of pocket. I don't need to worry about it. How quickly do you think you could deplete your savings? Very quickly. I had a client I was working with. This was when I first got into the industry. Single woman, no dependents, no husband, but she had several $1,000,000. Like, you would think she was doing great. But every month she was calling me up, Chantay, can you send $20,000 to my nursing home? In one conversation, she said, I hate this. I saved up all this money and it's depleting just to pay for long-term care. You can avoid that, just by having protection in place attached to a permanent policy. And that cash value that grows inside of it, the reason why we like it is because when that money is growing inside of a policy, you can get some tax-free growth. I'm going to talk about taxes in a little bit. It's creditor-free. So if you have a lawsuit against you, no one can come after that money. There's zero market risk. Cash inside of a life insurance policy is treated differently than normal investment accounts. We don't lose money. There's certain policies and strategies where you don't have to worry about losing anything. And later in life, you can take money out tax-free. I love it. It's like green bells all around the place. And the nice part is you can use it for whatever you want. Some accounts, and I'll touch on a few in a little bit, they give you the opportunity to grow money tax-free, but there's some restrictions built around it. When the cash value inside these policies, you can use for anything, your wedding, retirement. I use these for my children because I want to have money for when they become adults. And they can use it for college. They can use it to start a business. They can use it to buy a home. You can use it for whatever. I'm using it for my own policy, for my retirement. So you can be strategic. We've long gone are the days of the 1980s whole life insurance policies. Those are so old school. We have so many good strategies this year that we like to teach people about. So milestone number 3 is emergency fund. I'll go through this one pretty quickly. We always hear this, right? Have 3 to 6 months of savings in an emergency fund. I would say though, since COVID, since the pandemic, this has become more important. Wouldn't you agree? How many people do we see not work, not have a job? Couldn't, they didn't have that $400 in cash for the emergency, like Todd mentioned earlier. We recommend 3 to 6 months. Even nowadays, how many of these big companies are you seeing laying off people? And they're no longer being able to work. You want to have money set aside so that if you are no longer working, you can pay your bills comfortably for 3 to 6 months. Does that make sense? And, we always just tell people 2 rules. Number 1, only use it for actual emergencies. An emergency is not going out, hanging at the club, paying for everybody, drinks at the bar. And rule number 2 is don't get upset if you have to use it for a real emergency. Just start saving it back up. So it's interesting. Some people say their emergency fund. They're like, oh man, I had to pull $1,000 out to buy new tires. I was like, great. That's what it was for. You didn't have to use a credit card. So be proud of yourself that you had that money there. Milestone number 4 is managing your debt. And for me, I think this is probably one of the number 1 reasons that people don't get ahead financially is because of debt. For many, debt is the greatest obstacle to a sound financial future, becoming financially independent. One of the sayings around here is you are never financially free if you owe someone. We want to teach people how to get out of that sucker lifestyle, how to free up their income, how to start saving more money. How do we reduce our debt? I never like to overlook that top statistic. The average American has $28,900 in personal debts, not including their mortgage. We're talking about just in credit cards, auto loans, personal loans. People are overwhelmed. And then what does that lead to? Anxiety. If you really sit down and have an honest conversation with someone, they will tell you the one thing that keeps me up at night is I have so many bills to pay. I have so many creditors. I owe so much money and I don't know how to pay them off. That's the one thing that keeps a lot of people up at night. So real quick, some 5 quick tips. Number 1, just know what you owe. Sometimes people have that big old stack of paper on their kitchen table. Open the envelopes. What's the interest rate? What's the balances? What's the minimum payments due? Just itemize it. Just take a look at it. Get your head out the sand and let's look at these numbers for real. No more late payments. Do you know how hard or how much a one late payment will set you back on your credit score. It will sit on your credit report for I think it's like 2 or 3 years and will drastically decrease your credit score. Just because you got one late payment, you could have paid it one day late. And that creditor will report it to the credit bureaus and it drastically affects you. Don't have a late payment, set some alarms. Let's just at least pay the minimum. Target one debt at a time. Stop charging and cancel unused subscriptions. This was huge for me. How many subscriptions did we sign up for during pandemic? Like I have 3 kids, so I had to get Disney, Netflix, Peacock, every Tubi, every streaming service I had to sign up for. And it got me because it was like, oh, it's just $2.99 a month. And then what happened like 6 months later? It's like $10.99. And it adds up. Those subscriptions. How many of us had an unused gym subscription that we didn't use? We haven't gone to the gym once. And refinancing your mortgage, that might be an option. One thing we recommend is for anyone, know what you owe. Pull your credit reports. You can go to annualcreditreport.com. You can get your free credit report from all 3 credit bureaus, TransUnion, Equifax, and Experian. And it says you can pull it every 12 months. Actually, after COVID, they changed the law to where you permanently can access your credit reports once a week for free. So go and do that. Just see, what are the creditors reporting? Because some of that information might actually be inaccurate. It could be inaccurate. You can dispute it and have it corrected. All right, milestone number 5, which is increasing your cash flow. Sometimes don't we just need to have a little extra income? Sometimes people say, like, if I just had a little extra $500 a month, if I had a little extra $1,000 a month, that would really, really help me out. And then managing your expenses. So just a couple tips, quick tips here. Create and stick to a budget. We hear that all the time, but do we do it? It's hard. I raised my hand when Todd said, what are we spending? I'm like, overeating. That's my biggest budget item, but at least I know it. Some people don't know. Develop a written game plan. Shape spending on your car and homeowners insurance. Did you know that if you actually increase your deductible on your policies, like most people start out with like a $500 deductible on their insurance policies. If you increase that deductible to $1,000, your insurance rate will go down. The cost will go down. Reposition your savings. Remember how Todd was talking about the average savings account is what, 0.015%? That was sad, right? Do you have any idea how many people actually do that? Over $11 trillion sitting in those type of accounts, earning less than 0.015%. People just don't know. They don't know any better. So we thought, how about we reposition your savings from a low interest savings account, like what he mentioned, to something where maybe you're earning 3%, 6%. I would love that 9, 12%, right? And if you have enough equity in your home, talk to your lender, you can drop the private mortgage insurance as well. That'll drop down your mortgage payment. Some other 3 things you can do: have a side gig. I know a lot of people who have like a little side something, the side hustle they're doing. Wouldn't you agree? Whether it's like they're doing like ride share or delivery things or just working part-time at a big retail store. A lot of people are looking for side income because they need it. I 100% agree with that. We live in a gig economy. There's no shame in doing that at all. Me, I came here and I saw an opportunity to start a business. And trust me, I was never entrepreneurial minded. I wasn't like Todd at 18, hustling paint and slinging paint around. I thought I would take the corporate route and just get paid, work my way up. And then I got introduced to this. And like Veronica, I fell in love with teaching and started opportunity to have a business and grow something significant. Or if you're still working, just adjust your W-2 allowances. It's tax time, right? Tax season. If you're getting back a big refund, it's because you're paying too much in taxes to the government. And you could be saving that money throughout the year instead of waiting for that. I got $6,000, $7,000 refund. You could have been saving that $6,000, $7,000, earning monthly compound interest and growing it a lot more versus giving it to the government. Did they give you compound interest on your refund? No, they didn't. You can adjust your W-2 allowances to make sure that less taxes are taken out through the year. Milestone number 6 is building wealth. Avoid the impact of taxes, losses, and inflation, but also accumulating and growing your money. This is where we talk about investing in the stock market. Isn't that sexy? Everybody wants to invest in the stock market. Everybody. I'm like, do you have an emergency fund? We talk about investing. But something we touched on earlier is the big question. Remember how the statistic was 33% of Americans have zero retirement savings? The other part of that is, will your savings last as long as you do? How long will your savings last? According to Allianz, they did a survey in 2017. 63% of people have a greater fear of running out of money than actually dying. That's a scary statistic. And so when we think about building wealth, I want you to think about not just, like I said, I'm in my early 40s, retirement is still so far down the line for me. It's very hard for me to think 25, 30, 40 years from now, but I have to, because if I truly want to build that wealth, I have to understand there are threats to me not getting there, to not growing my wealth. And then a lot of times, what's our biggest setback here? Procrastination. like Todd mentioned, we just wait. We'll say, you know what? It's easy for me to say, oh, well, let me just get my kids off to college. Let me just pay off all my credit cards. And then I'll save. Let me just move into a new house. And then I'll save. Let me take care of my mom. And then I'll save. Do you ever get to saving? A lot of folks don't. They procrastinate. And then they get into their 50s and, close to retirement. They're like, oh, crap, I gotta catch up. So procrastination is hands down our favorite form of self-sabotage. That's why we teach these workshops, because I want to tug at something in your heart to make you say, I should do something. Or maybe I'm not doing enough. Or maybe I am. Let me just get a second opinion. So the first threat that we have to overcome is the impact of inflation. We talked about the rule of 72. So thinking of inflation is the tax of time. Wasn't inflation crazy a couple years ago? It was like 9%. Gas prices were over $5. I'm in Indiana, so it barely hit us as much, the gas prices. But I have to think, if I retire in 25 years from now, how much will that gallon of gas cost then? That's when we use the rule of 72 to calculate how will inflation increase the cost of goods and the cost of living? So 72, you divide it by the average rate of inflation, which is 2.8%, means that whatever goods and costs you're spending now, it will double in 25 years. That's exactly when I plan to retire. I have to make sure, why do we care about this? Because I need to make sure that my savings is at least keeping up with inflation, because I'm going to have higher costs and expenses in retirement. Does that make sense? Yeah. And the impact of losses. A lot of people like to invest in the market. Have you heard what happened to crypto? Like in the recent couple of weeks? It was like 100,000 something, then it's down. Do you know what most people's strategies are for investing their money? I'll show you. Crossing their fingers, making a wish and hoping, oh, that TikTok person told me to go and invest in this, and these are some ETFs I should buy, and I'm just going to cross my fingers and close my eyes real tight, and that money should grow. That's not investment strategy. You want to work with a securities licensed investment professional to really help you, because you have to think about losses. What if you had $10,000 and you lost 50% of it? And I posed that question. If I didn't have the image up there, a lot of people would, I said, how much do you need to make to get that money back? They would say, oh, I need to make 50%. I lost 50%. I need to make 50%. Is that true? Nope. No, you actually need to earn 100% to gain it back. So 3 strategies that we help folks with is, 1, how about we look at strategies where we minimize your risk as much as possible? Like, just because it usually loses money or strategy usually loses money, does that mean I have to lose? No. There's strategies out there that protect you and give you some protection. Diversifying your portfolio. Let me tell you what diversification is not. It's not having an account open at this company, that company, this company, and that company. People think if I have accounts open at all these companies, that's diversification. That's not. It's diversifying your asset classes. What sectors you're invested in, what industry, what type of investments you're using. That's diversification. And then utilizing financial vehicles. That's where a financial professional will give you access to financial tools and products that only we can give you access to. A lot of people don't know, you can't just Google your way to an investment strategy. You're going to get to a point where the website will say, now contact your financial advisor if you want to use this strategy. A lot of people don't know that. And the impact of taxes. Was it Benjamin Franklin who said nothing is guaranteed in life but what? Death and taxes. When I teach a lot of my workshops, I talk about tax. I actually start with taxes, because where you put your money will determine how much you get to keep. We all got the same uncle. You knew that, right? Yeah. Uncle Sam? We're all related.
The richest uncle I know.
I know. He's always trying to take from us, right? Wherever you keep your money determines how much you get to keep and use in retirement. Do you get to use your money for vacationing, or paying the government, or leaving to your children, or paying the government? It depends on where you put your money. And so let's have an example. What if you had an account, you had $10,000 and you were 29 years old? You put that in an account that was earning 9% compounding interest. That account would later grow to $250,000 by the time you were 65. Now, would you rather pay taxes on the seed, the first $10,000, or would you rather pay taxes on the harvest, the $250,000? You want to pay as the lowest amount of taxes, right? You want to keep the most of your money. I would rather pay taxes on the seed. And so we teach people, what accounts can you open? Because no matter where you put your money, it will fall into either a tax now, tax later, or tax never accounts. Did you all know that? I remember when I learned this, I was like, oh my God, I want my accounts, I want my money in the tax never. How can I get there? And why does that matter? Have you all heard like how much debt the government has? They had to create like a new word for it, like bazillion or something. Like, we have so much debt that our government has accumulated over years. I'm not considering no particular administration. And thinking about the future of our economy, those debts will have to be paid. Who's going to pay them? We will pay it. And how? Taxes. You think the government could just borrow money from us, borrow money from a bank to loan it to the US government? We see a lot of governments, not even just our US government, our local governments and state governments, they raise taxes. We're the ones who are going to bear the brunt of that burden. Let's be financially smart and make sure at least where we put our savings is in a good place. And then the last thing I'll just talk about, this is about retirement, because some folks are like, I'm about to retire pretty soon. Great. Number one, when we get to retirement, you have that big lump sum amount of money. We have to still have that money keep growing. It just doesn't stop and we just start pulling money out. You still want your money to keep growing, maintaining potential growth. But remember, I talked about there's ways where we can completely remove that risk. I don't want you to be in your 60s and 70s worrying about another 2008 happening. That's completely unnecessary. You don't ever have to deal with that. But also creating a predictable income that will last. Remember, we talked about we're likely to last a very long time. Making sure that our income lasts as long as we do, we could just implement the right financial strategies and create guaranteed income for ourselves. All right, milestone number 7, and then I'll wrap up with a couple ending slides. Protecting our wealth. Now, you've gone through, let's assume you went through all our workshops, you sat down with us one-on-one, we helped you with your plan. It makes no sense to make all those good financial decisions and not protect your wealth. And here, we're talking about protecting all the money that you've accumulated and making sure that it goes on to the people that you want it to go to. Do you know these 2 people? Prince, have you heard of Prince? Aretha Franklin? Prince passed away in 2016. He died with $150 million estate. Aretha Franklin died in 2018, and she passed with an $80 million estate. And you would think these rich superstars would have legal documents in place, but neither one of them had a will when they passed away. And their estates were in court for years with family members fighting over who gets what. And most people think estate planning is just for the rich. It's not. Everyday people need these documents. We're recommending having 4 documents at minimum. A will. This is just where you have your wishes in writing. Who gets what if I pass away? Who's responsible for finalizing my estate when I'm no longer here? We call it an executor of the estate. And that's in writing so that person can handle your business, close your accounts, make sure your assets are distributed. A financial power of attorney. If I can't make financial decisions for myself, who can I give that authorization to do so for me? Same thing with an advanced healthcare directive or living will. When I can't make medical decisions for myself, who can I let know in advance? What do I want? What type of treatments do I want? I don't want my family members fighting. Do we keep her on the plug? Do we not keep her on the plug? Have it in writing so that your family does not have to struggle. Trust me, my family went through this. I had an aunt who was in her mid-40s, had a major stroke, and was on life support. And the doctor was saying, should we do the surgery or should we not? And it was the most devastating decision that my aunts had to make. Unfortunately, she ended up passing away before we could even make the decision, but we didn't know. We didn't know her wishes. We didn't know what to do. We don't know. And then the last one is having a HIPAA release, having someone who could have access to your medical records, who can help you take care of yourself and make those healthcare decisions. If you don't make the decision, who has a plan for you? Your state. Now, we're in the state of Illinois, and they can't figure out a budget. I definitely don't want to figure out nothing to do with my money and my estate and making any decisions for me. That's when you have to go through courts and probate, which can be expensive and time consuming. And then you're trusting a judge to make decisions about your family who they know nothing about. Well, they have no clue what your actual desires were. So we encourage people to have a plan in place so the government's not in it. And then even if you wanted to have a really tight plan, you have a trust. Have a trust established. This is where you could create a separate entity to own and manage your assets, have complete privacy. You don't have to deal with courts. You don't have to deal with the judges. You can protect your special interests of your children, especially if you have special needs children. It's super important to have plans in place for them. Again, avoid probate. Like if you have property in Illinois and Indiana or another state, your trust can protect those assets and potentially lower your estate taxes. We actually work with companies who will create all 4 of these documents completely free, no cost to you. Ask the person who invited you, they'll give you access to a program we use to help create these documents. And then we work with a estate planning company that can create your trust at an extremely low discount, much, much less expensive than going to an attorney direct. So if you think estate planning would be too expensive or time consuming, then you haven't thought about your family having to make these decisions. Because I'm pretty sure we've all seen someone where a loved one passed away. And then I think of my big mama, and sometimes your grandmother is the matriarch of the family. My grandmother passed away. Her children were fighting over her house, fighting over her silverware, her couch, her jewelry. They didn't know what to do, what she wanted. And it's hard. Families really can struggle. We encourage folks, take advantage of the resources and get yours done. Then don't wait till it's too late. Check that milestone off immediately. So I talked a lot. It's a lot to think about, right? It's a lot to process. We actually have a PDF worksheet that the person who invited you can share with you. It's called a money discovery PDF document. And it just helps you organize, because sometimes you just need to just get it like, where am I at? We also have an online personal financial website that if you're interested in, it helps you get helps you get your finances electronically organized. We could share that with you. Someone can show you that. And then also, at the end of the day, just get that professional help. It does not hurt to just have a conversation. You know, again, no judgment here. We work with people of all kinds of backgrounds. Have someone sit down, look at your numbers with you. One of our associates here, they are well qualified, whether it's them or someone else who can come in and at least tell you, are you on track? Here are some opportunities. These are some things you could be doing. That's it. Sometimes just having that knowledge, knowing which money milestone that you need help with, sometimes that just gives us the confidence to move forward. Now, before I wrap up here, was this a great workshop?
Yeah.
Was this good? Okay. We actually, if you look at the back of our book, our books are endorsed by a national nonprofit called the Heartland Institute of Financial Education. We've actually worked with this national nonprofit since what, like 2012, over, I didn't even know it was that long. A lot of us became certified financial educators through their program, and we actually can teach this type of financial literacy workshop at your workplace. How many of you all know that your job, you and your employees, your coworkers need to hear something like this? The Heartland Institute, they actually have grants available where we can, if you introduce us to your human resource department or like your employee benefits department, we can share with them our course. It'll be sponsored by our nonprofit, so they'll know we're not trying to come in there and sell anything. We're literally just there to teach. We have grants so we can host a free workshop at your workplace at no cost to you. So we wanted folks to know about that. They sponsor all of our books. So all of our books are sponsored, and our courses are sponsored endorsed by the Heartland Institute of Financial Education. They specialize, they're a nationwide company based in Colorado. They specifically work with organizations and teach. Not only at companies, we've gone to school district, churches, other nonprofits, community centers. So if you know those type of organizations that could use a financial literacy workshop, just make the introduction. We'll come in there. It'll be no cost because of this grant. Okay. All right. Another thing, our next workshop will be coming up next month. I'm excited for this one because we're going to be teaching about our women's book. So March is Women's History Month. And in honor of Women's History Month, we're going to have a course called How Money Works for Women. It'll be based on our book here, our women's book. On Tuesday, March 31st, you can actually scan the QR code. And all the women scan the QR code so you can come and join us. We're going to have some wine and cheese and crackers. You come on too. The men can join as well. But we want you to know that we're hosting it. It'll be here, and we'll also have it on Zoom. So for those folks on Zoom land, please join us. Women, we tend to have unique financial situations, different from men. You know, we're the first ones to stop working to take care of our children and our parents, where we typically outlive our spouses. You know, we die later, much later. Our partners tend to die before us.
I'm gonna say it like that.
You're right. I didn't say it.
Not eating or cooking no more.
We tend to take on the primary responsibility for special needs family members. We tend to have lower wages still. There is an income wage gap, unfortunately. So we have different financial circumstances. We also deal with, unfortunately, domestic and financial abuse, which can affect our finances. So we're going to touch on a bunch of all those topics. We deal with divorce. I can keep going on about some of the unique situations. So invite any woman in your life. I don't care if she's 19 years old, just getting started, to someone who's already retired. We're actually going to talk about women's finances through every single phase in their life and their journey. And then the last thing, if you all could please complete an evaluation. So for all of our guests, if you could, in our office, if you could have an evaluation to complete. For those of you on Zoom, please scan the QR code and give us your feedback. We want to know, how can we improve? What was helpful for you? You're able to actually also request a free, no obligation consultation with the person who invited you. And you can actually indicate if you know a company or organization who you want to have us, host a workshop with. Okay. So that's all we have for tonight. Thank you all so much for joining us.